main emphasis of the IRAs is that the transactions are at arm's length, right? So there has to be some basic level of analysis or basic level of documentation to support that my transactions are at arm's length, right? So obviously the transfer pricing memorandum reduces the efforts, reduces the burden on the taxpayer in terms of efforts, time, costing, etc. But there has to be a minimum basic level of document to support, right? So it's like something is better than nothing. So it should not be that, uh, for entities whose revenue is less than 10 million, they cannot be picked up for scrutiny. Of course, the probability of cases being picked up for scrutiny or being asked could be more for companies who are exceeding the threshold, but companies who are not exceeding but have peculiar transactions like intangibles, etc., they can also be be asked for a requirement that how have the company determined the arm's length price. So that's why it's very important for companies whose revenue is less than 10 but your transactions are exceeding the thresholds. It is recommended or it is suggested that you should prepare a basic level of documentation to substantiate the arm's length principle. So these are the main two buckets depending upon your company revenue and the transaction thresholds, that which documentation needs to be prepared. But the main takeaway here is that the main or a basic level of documentation is needed. Now coming to the key amendments made to the Singapore Guidelines 7th edition. So the Singapore guidelines are obviously updated time to time. The last update which we have received is last year in June, right? So now it is known as the 7th edition. The first edition came in 2006. So there have been multiple amendments after every 3 years, 4 years. Uh, some of the so in this slide and the next slide we have captured the main key amendments, right? Which we as professionals want to make aware and to make understand that these are some of the important amendments for a company or any professional who is dealing in transfer pricing. So the first and foremost is that effective 1st of January this year, that is 2025, which is in Singapore tax terms year of assessment 2026, right? So from effective of 1st of January 2025 this year, the threshold for benchmarking or covering transactions related to intercompany services or any other transaction. Any other transaction would include leasing of property, grant of right for any property, royalties, brand fee, license fee, trademark fee, corporate guarantee, and any other transaction. So for all these transactions, now the threshold has been increased from 1 million, which was till last year. Now it will be 2 million, right? So obviously, this is a welcome step from the IRAs that they are giving more benefit to the taxpayer, but at the same time they still require that the company has prepared some basic level of documentation, whether it's the full version or the memorandum or a simplified version, to support that whatever transactions you are covering, they are at arm's length. But the threshold stands as of now. The only change here is, which is what we have mentioned, for sales and purchases, the threshold remains the same, which is 15 million, 15 million Sing dollars. So there is no changes to this. The second and the third are quite significant because of the fact that previously, we have had seen a lot of intercompany loan arrangements which were primarily interest free, right? So it could be lending of money from the Singapore entity to another related party or borrowing of funds from another related party. So in some cases, we have seen that it was an interest free kind of arrangement. Now, there are a number of reasons for this given by the taxpayers, right? But in practical situations, unless and until the loan has been given for a maybe a very peculiar economic circumstances, but practically in a third party scenario, because TP is all about comparing with the third party situation. So for a third party situation, interest free kind of a loan arrangement is generally not considered to be the correct approach. So that's why keeping into consideration, the guidelines have also got amended. And now first is point 3, which I want to mention, that an interest free related party loan, right, shall now be concluded as non compliant. So the in a simple term, the concept of interest-free loan has been done away with, right? So now coming to the point two, for related party loans, domestic or cross-border, if entered in or after 1st of January this year, the Singapore entities can either apply the IRAS, indicative margin, which the IRAS has given, on its website. Uh, for that also, the indicative margin, would be applicable for loans after financial year 2022, which have been, entered and been updated to make a reference to the RFR, which is the risk-free rate. Otherwise, the normal interest rates of the LIBOR or SIBOR, London Interbank offer rate, etc. But these indicative margins are published on the website of the IRS. So generally speaking, this is applicable for loans which are below 15 million Sing dollars. But if there are more than 15 million Sing dollars, the principal loan amount, not the interest, then there has to be a proper interest rate benchmarking analysis, right? So this is obviously depending upon, what is the principal loan quantum, but whether it's more than 15 million or less than 15 million, the bottom line is that there has to be an interest component attached to the loan transaction. So it cannot be an interest-free loan arrangement. So this is something which is quite significant. So it would be good for companies, to have an understanding and see their loan arrangements, and wherever there is an interest-free kind of situation, that needs to be very, very carefully, analyzed now. Now, one of the another very key amendment has been given is point number 4, which is the working capital adjustment. So in transfer pricing, apart from working capital, we have many comparability adjustments, right? The other comparability adjustments are known as risk adjustment, uh, capacity utilization adjustment, depreciation adjustment, and many other adjustments. So these are basically permissible by law, and they are done to improve the differences between uh, comparable companies or the benchmarking analysis companies and the Singapore entity or the tested party, right? The main caveat here is that the companies can perform any kind of adjustment as long as it improves the comparability, analysis, right? So obviously there is a full detail on this, so that maybe we will be covering in our subsequent, webinars, because they are in themselves a detailed topics. But here, as we are wanting to share the key guidelines, so the IRS has provided a lot of detailed guidance on conducting working capital adjustment, including how you have to determine the interest rate. Primarily, this is applicable for three methods, which is the transactional net margin or the resale price or the cost plus method. Because in primarily these kind of methods, we are comparing the operating profit on margin on sales or operating profit margin on cost of the tested party. The remaining two methods remain the profit split method. So in that, it would be an allocation of or allocation of profits. And for the last method, which is the comparable and control price method, there will be the comparison of the price rather than the profitability or the margin of the tested party. So that's why these three methods are mentioned here, and the IRS has given allowance and guidance that companies can conduct working capital adjustments as a comparability adjustment, provided that it helps or leads to an improvement in the overall comparability analysis. So there is a specified formulaic approach for this, and based on that, if it leads to an improvement, and apart from the improvement, there has to be proper justification given in the documentation as to why the taxpayer has conducted a working capital. So it's not that for every kind of transaction you need to perform or you can perform. You need to give a proper reasoning as to why a working capital adjustment is being performed, right? Uh, the other amendments what have been given is that there is a specific disclosure now in the transfer pricing documentation regarding receipt of government assistance, right? Since the time of COVID, there have been a lot of government funds and assistance given to the taxpayers, eligible taxpayers, right? But there has always been, a point of discussion as to how the treatment has to be made for these assistances received from a transfer pricing point of view. So the amended guidelines have given a relevant information, primarily three elements, that what kind of assistance have been received, how it has been dealt in the comparability and the arm's length price analysis, and what kind of impact it is having on the comparability, analysis and the profitability of the tested party. So this is something, if in your case you have received, the government, assistance, uh, it has to be appropriately captured in documentation. So this is something, an additional information we would say to be captured in the documentation, and it needs to be mentioned, appropriately along with the guidelines, right? Uh, Now coming to the second last is that, updation of TP audit process. So this is something related to what the IRS has given, that, on the transfer pricing audit or scrutiny process, they have, provided additional information and documents which will be, asked from the taxpayer in the case of any potential audit. That could be, the business profile of the taxpayer of and the related parties, the financial informations, the core value drivers, the core functional activities, the core business strategies, and what kind of, pricing policies have been made and what is the basis. So there is, a little bit of more detailed guidance as to, what will be doing, what will be conducted in the first meeting of a TP audit process, and what subsequent information and documents they will be, requiring from the taxpayer. So if you see, uh, the authorities are, having or laying more emphasis now on that whatever analysis the taxpayer has prepared, they need to have proper documents in place so that it can support during the TP audit, process, and that helps in coming into a much more favorable, kind of an outcome rather than avoiding any kind of, disputes. Other noticeable amendments what we have, seen is there was, for an MAP, MAP application, mutual agreement procedures application. This is for, for resolving any disputes or for any ongoing, litigation of any transfer pricing transaction for the past. So there was an initial requirement of a pre-filing meeting with the competent, authority. In the pre-filing meeting, one has to explain as to, what kind of transactions are being disputed by the authorities and why, what is the solution for this. So that pre-filing meeting has now been, completely eliminated, so the taxpayer can immediately, proceed with a formal MAP filing application, and accordingly that will be evaluated and analyzed, and that will be discussed with the authorities. So one procedural kind of, hurdle has been cleared for more better resolution for the taxpayer. uh, then another noticeable amendment what we have seen is the no TP adjustment shall be made, relating to any gain, loss, or reduction from capital transactions. But the main requirement is that this transaction is not taxable or deductible under the law, right? The exception here is for the sale or transfer of fixed assets, even though it's a capital kind of, item. But in case of transfer of, sale of fixed assets, which is again, a movable property, that is something which will require a proper ALP or an arm's length price analysis. So this is something apart from this transaction, any other, capital transaction which is not having any impact on the taxable nature or the deductibility, that will not be related made to any TP adjustment. But the bottom line here is the proper description of the transaction, needs to be maintained by the company as to what kind of transaction it is and what are, the basic nature of this transaction. So that has to be, clearly documented by in supplementary documents like agreements or any other policy document, that what kind of capital transaction is this. Again, no markup is would be required in strict pass-through costs, right? Subject to meeting specific, requirements, that these are specific, totally pass through costs without having any significant additions from the taxpayer or the Singapore taxpayer. And there are nothing, no, absolutely, it's a pure and pure no plain vanilla kind of a cost which is having no impact on the taxable base, and there is no element of, contribution made by the taxpayer in this. And there are a couple of other requirements, but the main requirement is that it is absolutely a pass-through cost without having any significant, value addition from the Singapore taxpayer or the related party. So these are the main seven amendments, and the uh, I would say, in our experience, both good amendments as well as little bit of more emphasis on the takeaways which is in the, this slide, as to how it will be impacting, the taxpayer, right? So these are practical implications from our end, right, based on our expertise and based on our analysis of the, amendment guidelines. So this is obviously, the first one is still in consonance and cognizance with what the IRS has mentioned in its, in the first pages of the amended guidelines only, that they need a basic level of documentation that the company has prepared at least some basic level of information on documentation and analysis, that okay, our transactions, if they are not even meeting